Hello, and welcome to another episode of Get Your Fill, Financial Independence and Long Life, where we explore ways to achieve those two goals and we invite experts on to help us. And that is why I'm so excited Jamie Lima is here with us today, because he speaks to you, the emerging millionaire. I love that term, Jamie. He is the founder and president of Woodson Wealth Management. And what they do is they help you to juggle all the different options that you have for where to put your money so that where you're putting it is going to put you in the right place, right? Like Jamie says, well, I'll let you say it, Jamie. You might not be a billionaire today. Thanks so much for being with us today, Jamie.
No problem. Thanks for having me.
So what's the end of that sentence? You might not be a millionaire today, but
the line I always go back to, and I should trademark this. We do have the emerging millionaire method trademarked, so we're working on that, getting that. But the line I always use is, you may not be a millionaire today, but if you do all the things that will help guide you and help you set goals with and so on, one of these days we'll get you there. And that's
so you don't have to live to be 147 or something like that.
No. We can, if we do some very simple but very strategic and key things, along the way, we'll put you in a better position to do that. That's for sure.
Okay, good. So Jamie, the one thing I didn't say in your introduction is that this is a fee-based service. So, like instinctively I think, oh, well, I'm trying to save money. Why would I want to pay for a financial planner when all these other people are willing to do it for me for nothing, right?
Yeah, I don't know if anybody's doing anything for nothing, right? unless we're volunteering or working for a 1031, a 501c3 organization or something. But I think everybody has an MO. As far as the term fee only goes, I think us as advisors, as fee only advisors, we're, I guess, in a lot of ways, the new wave of advisors that are coming down the pike here. And where the term fee only comes in is really, we don't deal with commissions. There's no sales quotas. There's no product sales. We're totally product and solution and platform agnostic. So for those that are out there that are saying, well, I'm hesitant to go, engage a financial planner because of all the fees. The reality is that there's literally only one fee that you pay to a fee only advisor, and that's the fee that you pay for the advice.
Takes any kind of even implicit bias, even a bias that you might not even be aware of, an unconscious bias toward a specific product, right? Because I'm a real estate agent and I noticed that most financial planners are never going to recommend that you put real estate into your portfolio, even though it can be a really great wealth strategy, right? Because they're not making any money from that.
Absolutely. Like I said, nobody's doing anything for free. So with a fee only advisor, again, we're product and platform agnostic. So and I've been a financial planner for 17 years now, and I've worked at a couple of big name firms. I now run Woodson Wealth Management, my own company. But even in my old life where I was working for these big name firms, you're playing in that firm's sandbox, so to speak, right? They want you to use their managed money solution. They want you to use their mutual funds. They want you to use their annuities or what have you, because it's all about fees, money. Whereas if, Chris, if you came to me and said, hey, Jamie, I'm considering life insurance, or I'm considering this type of solution for my financial life or so on. My job is really just to help you do the analysis on that to make sure it's viable for you, and it makes sense, not only to help you achieve the goals that you have, but also mathematically makes sense, and then help you go out and get it. So there's a big difference between how we operate versus some of the other firms.
Yeah. So have you always been a financial planner? Has that always been your forte, your passion?
It has, and we talked, before we jumped on, and started to hit the record button, that you're in Boston. I grew up in Rhode Island, and just a little bit about my background. I mean, I don't know what your background is as far as how you grew up, but for me, we really never had any money. I grew up in the middle of nowhere in the tiniest little state in the Union, and when you're young and you don't have a lot of money and your friends have all these nice cars and nice clothes and all this other stuff, you kind of tend to gravitate towards the thing that you don't have, right? So early on, I knew I wanted to get into business, some form of business, and run my own business one day. But I also had a passion for learning about investing and how to make take the little money that I did have when I was working. I started working when I was 13, taking that money and making it grow. And I wasn't really able to start doing any of that until I was closer to my 18, 19, 20, somewhere in that age range where I could start cutting my teeth in investing. But I always had a passion for it, and that's what ultimately led me to this role.
So it's interesting, Jamie, because you obviously had some kind of an understanding about money because, a lot of people in your situation, they wouldn't be thinking, oh, I want to invest my money. They'd be thinking, I want to save up for this hot car, right? I mean,
Yeah,
how do you think you got that
it's a great
background or
question.
that,
Yeah, it's a
in,
great. Yeah, great question. I think when I started working at 13, I had no clue, right? It was, how can I buy more baseball cards, or how can I buy, more clothes for myself? That's when baseball cards were a thing. That tells you how old I was. But but as I grew older, and I had my first real, I think, what I would consider like a serious job when I was probably 18 or 19, right after high school. And so I was going to community college, and I was working during the day. And the gentleman that I worked for, he was a friend of mine. His father, hired me to do, simply just started off with in a desktop publishing role. So I did some, because I knew how to use computers. As one of the only people in the office at the time who knew how to use computers. And but he would take me along on, like, business meetings and different discussions that he'd be having. And it was awesome because he allowed me to join in even at a young age, to see how the inner workings of a business. And I think that's kind of what it might have sparked it, where, like, we're going to take these investors' money, so to speak, and we're going to grow it into something much bigger. And I think that if this is the first time I've actually really thought about where that spark came from, and I would think that's probably what fueled the flames a little bit. Yeah.
Interesting. So almost your own like rich dad, poor dad experience.
Kinda, yeah.
That's cool. So, and now how long have you been out on your own doing your own thing?
I launched my company about 2 years ago now. Yeah,
It's so
so
funny. So many people have started their business during COVID. This is like
yeah, my timing was
just
impeccable.
before.
Yeah, my timing was impeccable. I handed in my resignation letter, February 28th of 2020, and then 6 weeks later, the pandemic hits, and but I mean, it is what it is. But I think what it did was launch us into 100% virtual environment, and frankly, it's been amazing for the growth of my organization, because we work with people all over the country now,
Right.
versus having to keep it in our own backyard, where we can drive to somebody's home or they can come to your office. Now everybody's so used to working in this environment, it just makes sense. I have clients in Massachusetts, Rhode Island, Virginia, Florida, South Carolina, North Carolina, you name it. And because of the environment we're in. So I think it's been a blessing in many ways.
So what is when you're searching for, you're targeting your emerging millionaires, is there sort of what do you call it? Like an avatar that you are a person who you're like, these are my ideal clients. These are the people who I ideally want to work with.
I think so. I think answer that question two ways. The first way is, the client avatar is those that are making over $100,000 a year, that have some level of wealth saved for themselves, and which would allow us to be able to help them make better investments and so on. And mid-career professionals, those that are probably 5 to 10 years into their career, now starting to make a lot, should say a lot of money, but a reasonable amount of money, where they're getting to the point where they're like, okay, at the end of the year, now I'm starting to have tax issues. I'm starting to have think about making other investments, like leveraging a realtor for real estate investment, maybe upgrading their home, putting little Johnny, little Susie through college, and then also managing things like workplace benefits in stock plans, and employee stock purchase plans, and managing things like RSUs and incentive stock options, those types of things, because they can get really complex. So I say about 5 years into their career, because that's what I tend to find is that the first couple of years you're still building your career and growing and learning the ropes and so on, and then you start to get to like year 5 and year 10, you're like, wow, I kind of have this now, and now there are promotions and other incentives that are coming your way that put people in a position where they're like, okay, now I'm making some real money, I should probably get some help with it.
Yeah.
But the second component of that is the way that we've designed our fee structure and the setup that we have in the process we take clients through. we also wanted to make sure that we never priced anyone out. So we do work with some people that are literally just starting off. I have a good friend of mine who I'm actually working with his daughter. I can't believe I'm going to say this. His daughter's 26 years old. She was adopted, but so that's, so I don't feel so old when I say that, but so she has, just starting off and learning the ropes on how to invest in her 401k and what contribution rates to make and what medical plan to choose. And is it HSA versus FSA in the plan and so on. And even though she doesn't have, $1 million for us to bring to the firm and then invest in a traditional sense, we can still work with people like that because they simply pay us a fee for the advice that we provide, whether on an hourly or subscription basis every month. And they don't have to have $1 million in the brokerage account to work with us. So, our avatar might be a little bit different than some of the larger firms that are out there. And I'm totally fine with that.
Yeah. So, well, like you say, because you're not making a percentage of their assets on deposit or something, right? So it doesn't matter to you how much they have in the bank, just that there's enough to give you some flexibility, right?
Absolutely. As long as and the reason why I say those making over $100,000 is because we do have, we have an hourly engagement that some people have engaged us with, but for those that do want to have an ongoing relationship with us, we do have, it comes out to be, $3,000 to $4,000 a year as far as what the costs go. And we don't want to be a burden to anyone's budget. Right. So we don't want to price anybody out, but we also don't want to, make their lives worse by working with us from a monetary perspective.
Right.
So, we have to make sure that, and plus we're a very small firm. It's just myself and my relationship manager that right now, and I'll only work with about 75 clients. Versus when I was at my, the big name firms I was working at previously, one of which, if I said you absolutely know, being there in Boston, I had 450 clients I was working with. Now I'm only going to work with about 75. So it's a much more intimate setting. We get to know our clients at a deeper level. And so we have to have minimums in place because we still have to run a for-profit business, but at the same time, we want to make sure that there's a level of value there for the client as well.
But I would think even with just a consultation, right? Even just coming in and talking to you once a year or something like that, that there's still a lot that can be gained from that because you're getting some direction. Before we went on, you were talking about all the different options for your 401k, for your, your work sponsored retirement plan, all the different places you can put that money. And I actually read a study where if they just people just pick the first one or the one that they recognize, right? They don't have any idea. Who wants to sit there and research 25 different plans? Not me,
Sure.
Whatever,
Mm-hmm.
Just put me in whatever everybody else is in, But if people actually actively took the time to do that and figure it out, how much more money they would have had at retirement. So how do you kind of help them, crawl through all that mess?
Sure. Yeah. I mean, the one thing that we do with everybody that we work with is we do develop a financial plan for them. So, because in a lot of ways, the financial plan is the recipe that bakes the cake, right? So we want to make sure that we know where they are today, where they're headed, give them some guidance as far as what changes or priorities they should have in place and so on. And then once we have that in place, then it's much simpler to make recommendations for the portfolio. And that includes things like workplace benefits and so on. So once we've taken them through that process, which we do over a series of, a couple meetings, then we can say, okay, here are the recommendations for the portfolio that you have at company XYZ. This is what we think you should be investing in there. And but then we can go back to the plan and say, and this is why. It's less of a, I don't know, shotgun approach is not the right word, but the more of like kind of going about it willy-nilly, right? Because and like you said, that's what most people do is they either go with their default investment strategy in the plan. Most people don't know whether or not whether they're in the traditional investment in the traditional 401k or a Roth 401k. We can help them navigate all those things. The first thing we have to do though is build a plan. So we give the proper advice.
And I know that things like, I was talking to somebody else about saving for your kids' college fund versus putting money into your retirement. I mean, what do you think about, and people think, oh, I got to send my kids to college, but then all of a sudden the kids are out of college and they're like, oh, now what? We don't have any money.
Happens all the time. Happens all the time. And that's exactly the demographic we work with, the target client we work with is in that situation all the time, competing priorities. So what we have to do is, and that's where going back to the plan, with the financial planning software we use, we can literally show them, okay, if you take all this money and you put it in little Johnny, little Susie's college plan versus your retirement plan, this is the outcome. Are you okay with that? And if they're okay with it, then let's do it. If they're not, then we have to make some adjustments accordingly. The one thing I would encourage your listeners to consider in that realm is, it may feel good now putting little Johnny and little Susie through college, but how is it going to feel when you're sleeping on their couch at the age of 85 because you ran out of money? It happens all the time. There are boomerang children. There's also such thing as boomerang parents. Yeah. And it happens all the time. So you have to balance all those things out.
Yeah, I definitely wouldn't want to be. I mean, I don't have kids, but I wouldn't want to be sleeping on their couch one night in my retirement. That's for sure.
No, I want to, I have, my wife and I have 5 kids between the two of us, and they're all teenagers now, except for my youngest, who'll be 10 this summer, but love them to death. But I don't want to spend every waking minute with them, especially when I'm in retirement.
Right.
So you have to balance all those things out.
I mean, I would think a key to like a successful retirement is if you could know how long you're going to live, right? I mean, that's just such a big variable.
Bingo. Yeah, my job would be so easy if I knew when every one of my clients was going to die. My job would be, so much easier. But we have no idea. We plan for. When we run financial plans, we do, for a married couple, just to give an example, as far as a married couple goes, traditional husband and wife scenario, we plan to the age of 94 and 92 for each of them, because there's a 25% chance that a married couple, there's a 25% chance that someone in that married couple will live to the age of 93. Usually it's the wife, the wife, but.
Yeah. So that's reasonable. My aunt lived to 105. So that's my number.
That's what actuarial tables go. Actuarial tables go out to 105.
Yeah. It's well, I think that's part of the thing, right? Do they factor in like your family?
And that's where, I think you've heard of these robo-advisory firms that are out there, Fidelity Go and Schwab's Intelligent Portfolio and all these things. It's great to work, especially if you're just starting off and you want to look for the easiest, the cheapest way to have, get professionals to manage your money. But when you start making real money and you start needing more customized, more personalized help, that's where having a financial advisor comes into play, because a robot doesn't get to have those types of conversations with you to learn that, okay, hey, Chris, we need to make sure we're planning out well beyond the age of 100 for your retirement because of your aunt. A robot's never going to pick that up.
Right. Yeah. And that's what they should ask you. How long will you live? That should be one of the questions on the thing. How long do you plan to live? But so what other things are unique, do you think, kind of set your firm apart, sort of make you a little bit unique?
I think we talked a little bit about the fee structure. The fee structure is a little bit different. Very few firms actually do hourly engagements. So we do hourly engagements with some folks. We have set up what we call a subscription service, which is for financial planning and investment management. We can do a kind of an ongoing engagement. All of our engagements are long-term and ongoing, but rather than say, well, it's going to cost you $4,000 for us to build the plan, like some firms do, we say, you know what, let's forget that. Who's going to come out of pocket $4,000 right now to build a financial plan when you don't even really know if there's any real value in the relationship? So our thought process is we want to earn that relationship and earn that value over time. And we don't want to gouge anybody either. And I can't remember if I mentioned this earlier or not, but I'll say it again. Our mandate is we want to grow with you, not from you. So we charge a small amount up front just to get the ball rolling, so to speak, and compensate us for the time that we spend, the hours and hours we spend meeting with clients and building their financial plans and so on. And then we simply charge a subscription fee every month, a couple $100, whatever it is, depending on the client's situation. And just like any other subscription that they have, we they pay us monthly for it. And that could be a year-long engagement. It could be a 5-year-long engagement. It's really dependent on the client. They control all that. So it helps. I think it's a little more palatable to the budget. But unlike other subscriptions like Netflix and everything else, I think the value is exponential versus what they're getting in, their off their cell phone bill subscription or whatever. But that's a key differentiator. We are certified financial planners. So anybody, myself, and then anybody that we continue to bring to the firm, which we're in talks with bringing, with a couple different advisors that will allow us to continue to, me to continue to grow and scale the business. Because right now it's just myself and our relationship manager. But the plan is once I get to roughly, 50, 60 clients or so, which I'll be there by the end of the year, if not sooner, then it's a matter of just bringing on, other advisors to continue to grow. We never want anyone to have more than 75 clients that they're responsible for. So everybody that we bring to the firm will have that. We'll continue to grow and scale that by bringing more advisors on, not by giving the advisors that we have more clients, which is what other firms do. And then I think, I'm trying to think if there's anything really different. Oh, I mean, at the end of the day, the other thing is that, and I tell this to all of our prospective clients, we don't do 800 numbers here. All of our clients have access to our cell phone. They can call us, they can text us, they can send me pictures of their grandkids. I don't care, but we don't ever want anybody to feel like there's, a call center in between us and their ability to get the help they need. So that's, I think, a big differentiator between us and other firms.
Yeah, just being able to pick up the phone and not get a recording is it's huge.
Yeah, I mean, clients call me and text me all the time, and it actually works out better for me because I don't necessarily have to be sitting in front of my, in front of my laptop or anything. If I want to take off a little bit early on a Friday, I can go off and do my thing, and I can still be present for my clients when they need something.
Yeah, that's what I love about real estate too. It's just like,
Yeah,
I can be answering their questions from the beach somewhere. It doesn't matter as long as I'm available.
Absolutely.
Yeah. So what are some things that make a big difference for people? Like if you make this decision early on, that it can really just have, with the time value of money and, exponential sorts of returns or differences.
I think the number one thing that when we're talking with all of our clients about this right now is you leveraging Roth individual retirement accounts or Roth 401k Ks within their plan versus traditional individual retirement accounts and traditional 401ks. Like we said, so many times in our short conversation here, most people get into September, October, open enrollment period. They go, well, I'm going to put 5% away or 6% away into my 401k. They hit the submit button and they call it a day. They don't look and see, is that going into my traditional 401k? Is it going to my Roth? And it can have a huge, huge difference in your ability to live the lifestyle that you want in retirement. And maybe some of your listeners right now are like, well, retirement's so far off, what does it make a difference? Well, raise your hand if you think taxes are going down, is what I would say. So if they understand the nuances of how Roth retirement accounts were in versus traditional retirement accounts work, they'll recognize that once they get, beyond the age of 59 and a half right now, and they can start taking money out of their retirement accounts, it's going to make a big difference in their lifestyle, I think, because, I work for a very large company that runs pretty much every 401k plan in the country. And I used to laugh because, you'd have these, people that come in and go, well, I have $2-3 million in my 401k. I'm like, okay, that's great, Mr. Client. But if you have $3 million in your 401k, you really only have two because the IRS is taking a third of it. So if you had $3 million in a Roth, you have $3 million in your pocket. Yeah. So that's huge. And I think the other thing that I would say is when we manage portfolios for clients, we are managing taxes throughout the year. In not in the retirement accounts so much because you don't have to worry about that until you start taking money out, but in your brokerage accounts, the after tax money, the money that you're investing, maybe for to purchase a home in 5 years or what have you, those types of brokerage accounts, what a lot of firms will do is they just let the portfolio do its thing through the course of the year, and they'll look at, every December they'll go in, maybe one time a year they'll go into the portfolio and go, okay, well, what can we sell to harvest some losses to offset any of the gains that we have? Well, December is not always the best time to do that.
Right.
It could have been in July.
That's when everybody's doing it.
Yeah, and it's a lot. There's a lot of window dressing. There's a lot of volatility. You never know what's going to happen in December. So we will manage the taxes in the portfolios throughout the course of the year, not just one time a year. And I think that's a big differentiator too, because every year is different.
Yeah. So let's talk a little bit more, because I realize that I understand a lot about the different types of IRAs and stuff, but maybe other people don't. Can you just explain the advantage of a Roth compared to a traditional IRA?
Sure, absolutely. So with a traditional individual retirement account or 401k, I'm just going to say IRA because that's kind of right. An IRA, an IRA. So a traditional IRA, you get a tax benefit today, and the money that you have in there will grow tax deferred, meaning that if you buy something low and you sell high, and you have capital gains in that account, the capital gains are not, you don't pay taxes at that point. You only pay taxes later on, after the age of 59 and a half. When you take distributions out, you pay at whatever your ordinary income tax rates are at that point. A Roth is the complete opposite. So you don't get a tax benefit today. Money goes in, you don't get a tax benefit today, but the money still grows tax deferred. So anything you purchase within that account you're gonna have tax benefits along the way. And when you take the money out at the age of 59 and a half or beyond, it comes out tax free. So, and the beauty of, and another key difference between the two is, with a traditional IRA, at the age of 72, the IRS will tell you, Chris, you now have to take required minimum distributions out of this account because we've let you defer these taxes for all these years, and we gave you a tax benefit 20 years ago. Guess what? The tax man cometh. So now you have to, and it's a small percentage to start, and then it grows over time, and it's based on how old you are and your actuarial table age. There's a table they use, but every year that number grows. So the first year you might have to take out $10,000. Next year it might be 15, then 20, then 26, and then so on, and it'll continue to grow. With a Roth IRA, there are no required minimum distributions either. So what I like to see happen when we start, obviously the demographic we work with now are very, relatively young, but we do work with some people that are, heading on into retirement or already in retirement. And what we want to see when we're planning for retirement for these folks is we want to diversify their sources of income that they're going to be able to take over in their retirement. So we have some money in traditional accounts. We have some money in Roth accounts. We have money in their brokerage accounts and so on. And that allows them to, they get into retirement, they can let the dust settle and put their working years behind them. And then the first couple of years, we can say, okay, well, what does your tax situation look like? If you need X dollars a year, where's the best place to take it from? Should we take a little bit from the brokerage account and then the Roth, or maybe this is a year where you have very low taxes. We'll take it from the traditional account and pay taxes at a very low rate. And then we'll, kind of wash, rinse, repeat for the following year.
Because that's the theory behind the traditional IRA, right? That when you're working, you're in a higher tax bracket. And then when you're retired, you're in a lower bracket. Correct. But if you start investing young, that isn't even necessarily the case.
Exactly. Not to mention, we're not in regardless of whatever anybody's political affiliations, the reality is we just, over the course of the last year and a half, 2 years, created $3 trillion worth of stimulus. Who is going to pay for that? It's me and my kids and probably my grandkids. So we are in the very low tax brackets right now, relatively speaking. If you go back historically and you look at where the tax brackets were, 50, 60 years ago, we could be headed there again. So having money in different buckets, so to speak, and I know, who is it? Ray Lucia. Have you ever heard of this Ray Lucia guy?
I don't know.
He's barred from the industry now, but Ray Lucia came up with this strategy. Maybe he was on a radio station here in San Diego years ago, but he always came up with this thing called the buckets of money strategy. And I'm like, dude, that is financial planning 101, first off.
Just give it a sexy name.
Yeah, it's like, and he made gobs and gobs of money and then ended up, getting disbarred or whatever. But he, that's ultimately what you want to do, is you want to have different buckets of money, so to speak, and every bucket has a different job. And then you have much more flexibility in retirement, and you can manage taxes that way.
So how young is too young to start thinking about your retirement?
This is the true story. My stepson, Brandon, he just turned, he's going to be 19 here pretty soon. But the day he turned 18, we set up his Roth account for him. That was our gift to him. And we're going to do that for everybody. Yeah. And I think that every parent out there should consider doing something similar. Obviously, with Roth accounts, you have to have, the child has to have earned income, to be able to make a contribution, for him or herself. But and he has a job, and he's going to college and everything else. So I don't think it's ever too young, frankly. Even companies like Fidelity Investments have Roth for kid accounts where parents can contribute to Roth accounts early on. Yeah. So I don't think it's ever too early.
Because the magic of compounding interest, right?
Bingo. And I'm sure you've seen the study, and I'm sure many of your listeners have heard of this too, where and I can't remember all the details of it, but there was a study that was done that said, if you started at the age of 20, if you start at the age of 20 and you invest to the age of 30 and stopped, you'd have more money than if you started at the age of 30 and continued all the way to retirement, just to the benefits of compounding. Yeah. So the earlier the better. And you obviously don't want to stop investing, but I think, from a mathematical perspective, it's just amazing how compounding works.
Yeah, it really is magic. That's Warren Buffett said that, right?
Absolutely. Absolutely.
So what other things should we know? And what other, like a well-educated financial person, like what do you want your clients to know at the end of like your first session? What kinds of things do you want to make sure they get?
Great question. I think what I really want them to get in, our first couple of sessions, I want them to get first, I want them to get the sense that there's some value in these conversations, and there's a plan in place, and they know where they're going. But if you look at any of the social media that we do, and a lot of like the videos we put out on YouTube and Instagram and so on and so forth, it's not really about this investment versus that investment, or this insurance policy versus this insurance. Like every talking head financial planner is talking about those types of things. What I try to do, and maybe this goes back to, I wasn't a great athlete, but I did play sports growing up, and that athlete's mentality, and the biggest thing we want to focus on is setting goals. So, and we follow what's called the SMART framework of setting goals. And we want to make sure that the goals that we set for our clients, and they participate in this. This is, it's a back and forth ping pong session that we do with in our initial meetings. Is okay, what are our initial goals? What is it we want to work on first? Okay, and then we have to make sure that they're SMART. So are they specific? Are they measurable? Are they aligned? Are they realistic? And are they time bound? So maybe it's we want to buy a house in Florida in 2040. Great. Okay. So what size is the house? How much is it going to cost? Let's get super, super specific. How can we measure our progress towards it? Right? Are our goals aligned? Because how many times I've gotten into a conversation with, partners and husbands and wives and what have you. And, in client A, their goals are different than client B.
Yep.
So that's where, like, if they're not aligned, we might as well not even have this conversation, because the goals are probably never going to come to fruition.
Yeah.
Once we get the alignment, then we make sure that they're realistic. Can we actually do this, mathematically speaking? And then tell me again what the time constraints are. What do we need to have saved by this time next year, 5 years, 10 years, and whatever. And then I think we don't walk everybody through that exercise, because sometimes they come to us and like, this is exactly what we want to work on. This is the thing that we're doing today, but not everybody has that. They may have 10 different priorities, and we have to help them prioritize and then work on one thing at a time. But that's the one thing I want them, our clients, your listeners, our social media followers and so on to get, is that we can accomplish anything, so long as we follow a specific framework to get there.
And that's smart because it's often very abstract for people to just think about saving money, right? You to save for something or to understand how your lifestyle is going to look when you have this goal accomplished is so much more powerful than just, you know, dropping pennies in the penny, in the penny jar, and you're just like, okay, yes, that's gone, that wasn't that much fun after the 50th
Yeah,
time.
absolutely.
Yeah, excellent. So how about this? I know you have 5 children, so you perhaps can speak to this, like a way to get kids excited about the concept of
Yeah, I
saving
think
and, and not just like immediate gratification. Do you do any
absolutely.
exercises
Yeah.
with your kids?
Yeah, I mean, we started all the retirement accounts, and my next is my daughter, Madison, she just turned 18. So we need to get her squared away. But we're going to go through the same exercise with everyone. And we just set up a systematic savings plan for them where they know every month or every quarter they have to give me, because I'm kind of quarterbacking all of this, they have to give me a certain dollar amount based on how much they've earned over that month, because they don't have access to 401ks. They're just working at
Right.
fast food jobs, and Jenna's at Hollister, and so they don't have 401k access to 401ks. But I want to get them conceptually saying, okay, if I put away 10% every month, and then not only that, but do the math, right? Like if I earned $600 this month, what's 10% of that, and get them thinking about where every dollar is going to go. And so that's what we've done. And I think setting up, the other thing I really like to do with younger folks, not just my kids, but the younger clients that we work with, is setting up specific accounts for specific goals. Mm-hmm. Compartmentalizing the assets. And when they do that, I think everybody should have an emergency fund. Everybody should have 6 to 12 months worth of cash in an emergency fund to cover expenses in case something happens. But above and beyond that, where maybe it's a home purchase or maybe it's a car purchase, whatever it is, it's so simple to set up these savings accounts online now, where you can go find an online bank, an Ally Bank, or I don't know if ING even exists anymore, but those American Express or what have you. You can set up one account, you can set up 10 accounts. They don't care. And you can name them.
Right.
You can name them.
Like they
this
charge
is
you by the account.
Yeah. This is our car fund. This is our vacation fund, whatever it is. And then I think just going through that exercise of labeling it, giving those dollars a job, goes a long way in helping people save for the goals that they have. Because it's not just thrown into one gigantic pot and they're like, well, we have $10,000, $15,000 in this emergency reserve, but if we took 2,000 of it to go, I don't know, go away this weekend and go to Vegas or whatever, is it really going to hurt us? But when you see it in the account, you can see, wow, if I take $2,000 out of my car fund, I'm going to have to drive this, I don't know. I had a 1984 Chevy Cavalier with 4 mismatched tires as my first car. So we're going to have to, I did not want to drive that 1 second longer. So that would have impacted me then and said, okay, right, I'm not going to spend this money. I'm going to get,
right, that's going to come out of my car fund, and that's
going to come out. Yeah, exactly.
No, that's a good idea too, because you've got the, the latte factor too, especially I think when people don't already have some money put away, it's just like, well, we're already in debt. What's another, we might as well take the weekend and go to Florida because, we're already like $20,000 in debt. What's the point? What difference is it going to make if we take 2,000 more and just go on this vacation? Right.
Exactly. And then you
Excellent.
start, then you have to,
advice.
it's a long time to unbury yourself.
Yeah. It's really tough. It can be really tough for young people getting started, especially with student loan debt and all that stuff. So thank you, Jamie, so much. So what is that I didn't ask you that you wish I would have asked you?
Wow, that's a great question. I always end interviews with the similar question. Like, what did I ask that I did not ask? I think, well, maybe I don't know, if it'd be helpful for your listeners to learn where they could, visit our website and to contact me if they do have follow-up questions. I'm happy to do so. So our website is Woodson, which is WOODSON.WM.com. So woodsonwm.com. It's our website, and go through a little bit of a revamp there, so it'll be nice and fresh in the next month or so. But again, I people can reach out to me directly if they have questions. They can call me, they can text me. My cell phone number is 858-923-4500, 858-923-4500. It's kind of like Gary Vee giving out his cell phone number. Did he do that one time? But I don't know if I'm going to get as many
Maybe
calls.
you'll get as many calls as Gary Vee got.
Maybe I will. That'd be awesome. But really, I share it because I'm just here to help at the end of the day, and do what we can to put people on firmer financial footing and make better investment decisions. And if we can help, have a small impact in people's lives doing that, I think it's a pretty big deal for me.
Awesome. Jamie, that's fantastic. I love it. Yeah, I was going to ask how people could get in touch with you, but if you're an emerging millionaire, or you'd even like to be an emerging millionaire, then you have to call Jamie, because you can tell he's going to give you that white glove hands-on, like perfect loving care, right? That you're not going to get at a big firm.
That's the biggest difference, and I'm not perfect by any stretch of the imagination, and I don't know everything. So, but I think I've been doing this long enough where if somebody brings something to me and I'm like, I don't really know about that. That was a CFP exam question 10 years ago. I can certainly find the resource to help get the answers that people need. So
Awesome.
happy to help wherever I can.
Thanks, Jamie. And thank you, listener, for listening. I know you got a lot of benefit from Jamie, but don't keep it to yourself. Share with a friend, forward this message, this podcast to them, so that they can also get prepared to have their revealed inner millionaire, emerging millionaire, to start getting on their firm footing. And be sure to be with us next week. Have a good one.